On behalf of the Federal Reserve Bank of Dallas and in partnership with the Texas Department of Banking, I'd like to echo Donald's remarks and welcome you to the second annual 11th District Banking Conference. I'd like to personally thank Commissioner Charles Cooper from the Texas Department of Banking, whom you'll hear from at the closing, for his support in partnering on this event and his unwavering leadership and commitment to the Texas banking system throughout his remarkable career. The 11th District, which covers all of Texas, southern New Mexico, and northern Louisiana, is home to many community and regional banks. In fact, as the saying goes, everything is bigger in Texas and we can prove it. The state of Texas alone boasts the greatest number of chartered banks than any other state in the union. Since 2010, as the economy rebounded from the Great Recession, the number of regional and large banking organizations in the 11th District has also grown from 3 to over a dozen as a result of organic growth, mergers, and relocation of headquarters. Everyone's wanting to come to Texas. The blend of a very large regional and community banking system that operates here makes our district one of the most diverse banking portfolios in America, and I truly believe that preserving this mix is critically important to our Texas economy. The needs of our communities, from ranchers to oil executives, are able to find a bank that can work with them in this setup. Upon arriving 2 years ago, the idea of this conference was really born out of an effort to increase our transparency and outreach to district banks, which is why today we've curated content directly related to all of you as bankers, and particularly community bankers in the audience, in an effort to bring awareness and dialogue on risk topics that we feel are relevant, where your views are critically important, and where possible to provide networking opportunities to build relationships with your peers in the room. Today, I'd like to just briefly touch upon 3 topics that are front and center in the banking sector in our region before we get into our first segment: credit, liquidity, and cybersecurity, to set the stage before we hear from our President and CEO, Lorie Logan, and Gabe, our San Antonio Bank branch board of director. An area getting a lot of discussion right now is credit, and particularly commercial real estate. Now, commercial real estate is wide-ranging as a lending sector that is both critical to our regional economic landscape and to the community bank business model. So much can depend in commercial real estate on the class of the property type, the geography that makes general statements of CRE in general, as we sort of hyphenate commercial real estate, really kind of difficult to make broad brush statements. But I'll go into a few segments that are showing signs of emerging challenges. We've observed a lot of supply in multifamily units in the district with tepid demand. In recent years, multifamily loans have been the fastest growing loan type in banks in our district. The common assumption was that more apartments were needed to provide housing for all of the population growth the district was experiencing. Often a developer would pay records amount for a parcel of land or an older building and then build a new apartment building with a high-end finishes that would be priced on the high side in order to earn a decent return on the initial cost outflow. Higher construction costs in recent years due to material and labor shortages have pushed up expenses, as did higher cost of capital. We're observing that some of these properties are falling short of their budgeted projections and not stabilizing at levels to support a valuation need for permanent financing. Rents are lower than expected, occupancy at times can be lower than expected, and carrying costs also being a challenge. In some cases, the project sponsors are stepping in to cover cash flow shortfalls to keep interest payments current. When we see these trends, we're really looking for how our banks are working with their borrowers to finding solutions. And we are starting to see a small but uptick in non-current lending within this space. And with respect to office, we're also continuing to see high vacancy rates within the Houston, Dallas, and Austin markets, which is putting pressure on rents and valuations. While we're seeing more people return to work in the office, a shift from the pandemic work from home format, the vacancies still remain high. And then finally, an area that we're monitoring in commercial real estate is industrial properties that were built to accommodate international trade, given our region's location along the border. While these properties are built to serve a need, the recent uncertainty with trade policy are impacting some of their performance. While all of these levels are not immediately concerning, it bears watching to see how banks are reserving for this activity and what concentration levels may mean if certain sectors further decline. Turning to liquidity, we've seen a significant stabilization of deposit volumes district-wide, but the pricing for those funds has cut into profitability. We're hearing from banks, competition remains fierce. Banks and supervisors have been making a concerted effort in the last 2 years to ensure they have useful contingency funding plans and a variety of funding sources to tap into unexpected funding outflows if and when they occur. While Silicon Valley Bank was a very different business model than most of our traditional banks, the speed and magnitude of their deposit outflow showed us that operational readiness is key in today's modern digital world. Here at the Federal Reserve, we continue to work on improving our operational efficiencies and recently launched our discount window direct service, which offers online lending to depository institutions eligible for primary credit. In addition, our discount window efforts continue to work with the FHLB system to ensure that we reduce any operational frictions in moving collateral between entities. We have representatives from the discount window here with us today at our breaks, right outside the doors, that you can feel free to talk to and engage with should you have any questions. And finally, I want to mention technology and cyber risk, as it wouldn't be a banking conference unless we brought that up as one of our top risks that we're continuing to watch both as supervisors and banks. Now more than ever, our financial services industry is targeted by criminals to break into systems, to take customer data and wreak havoc on our larger financial ecosystem. As our society moves more and more into an ever-evolving technology world that we live in, all of us, bankers and supervisors, need to upskill in the area of technology, both to ensure our business decisions drive technology improvements and not the other way around, and to stay conversant on how we can proactively avoid the next vulnerability. I'm really excited for the crisis simulation that Donald had mentioned earlier today as a way in which to really get some hands-on discussion within that segment. And so you'll find ample discussion for that, as well as our commercial real estate panel and our discussions on liquidity during our time today. But before I get into the introductions of our first segment, I did want to end with this. As supervisors and bankers, we share a common goal in creating a healthy banking system in the United States that operates in a safe and sound manner and treats consumers fairly. It's important we don't lose sight of that goal now more than ever. It's the public trust built up from decades of supervisors and bankers working on the shared goal that makes this great American banking system work. Engagement at venues such as these are a valuable part of that process. With that, before I get into the introductions, I did also want to recognize some special folks that are in the room today with us. I wanted to acknowledge our regional executives of North Texas, Donald Bowers, who you heard from earlier, Guhan Viniktu, Armida Rijos, Darren Peschel, and Roberto Coronado. Our regional executives lead engagement here at the Federal Reserve Bank of Dallas with the local communities, businesses, and industries that drive economic growth across the 11th District. They play a vital role, as well as our supervisory staff, in ensuring that we build strong connections within our banking community day in, day out. I know that Donald was here earlier, and if he could just raise his hand, and Armida is also here with us today. So if you were able, if she can, where is she? Oh, there she is. If you can make sure to say hello to them, it will be great so that we can connect you with them, as well as our supervisory staff that are at the event. I also wanted to acknowledge and recognize that we have our Community Depository Institution Advisory Council representative, Cindy Blankenship, with us today. We thank her, as well as former Dallas Fed Board of Director, Kelly Barclay, who is also in the room with us today. So we want to thank those special guests, as well as our partners at the Texas Department of Banking. So with that, I think we can now turn into our introductions for our first conversation of our session. I'm going to invite both our president, Lorie Logan, and Gabe Guerra to the stage, and I'll have them come up, and then I'll go ahead and give a bit of an introduction to them, and then we'll kick it off officially. And also, as they are seating, Joe Quiroga as well, I believe, if he can raise a hand. Great. Joe is also our current Dallas Fed Board of Director member as well. So we're excited to have our special guests in the audience. So as we kick off this moderated session, it's my honor and privilege to introduce both Lorie and Gabe to the stage. Lorie Logan is the 14th president and CEO of the Federal Reserve Bank of Dallas. Prior to joining the Dallas Fed in August 2022, President Logan spent more than 2 decades working in the markets group at the Federal Reserve Bank of New York. She was previously manager of the System Open Market Account for the FOMC and an executive vice president at the Federal Reserve Bank of New York. She holds a bachelor's in political science from Davidson College and a master's in public administration from Columbia University, and she is a proud native of Versailles, Kentucky. Gabe Guerra serves as the director on the board of the Dallas Fed San Antonio branch. He is president and CEO of Clayburgh Bank, an independent community bank established in 1905 in Kingsville, Texas. Prior to joining Clayburgh Bank in 2007, he served as regional vice president at Wells Fargo Bank, responsible for indirect lending for the 12-state Midwestern region. He holds a BBA in finance from the University of Texas at Austin and is a graduate of the Southwestern Graduate School of Banking at Southern Methodist University. So with that, please join me in welcoming Lorie and Gabe to the stage.
Thank you, Emily. Appreciate that introduction. Good morning, Lorie.
Good morning.
How are you this morning?
I'm doing well, and it's great to see you here, Gabe, and thank you for all of your service to us here at the Fed, and great to see so many bankers from across our district and so many special guests. Thank you, Emily, for the introduction.
Thank you. I know you're quite busy these days, heading out to El Paso, I think, later this afternoon. So thank you for this time. On behalf of the bankers here today, thank you for your time and your commitment to the 11th District. I'll start with a few questions relative to our industry. Is just how are you viewing the economy overall right now, and what are the risks that are top of mind for you?
Well, it's great to be able to be here to talk about the economy as well as the banking sector. And I am off to El Paso this afternoon, and hopefully might see some of you who are in El Paso while we're there and listening to over the next couple of days. In terms of the economy, I don't think I need to emphasize to this audience that we've just seen a tremendous amount of uncertainty and financial market volatility in recent months. And despite that uncertainty and volatility, the overall economy has been pretty resilient. We have a dual mandate. That dual mandate is price stability and maximum employment. And if we start with the labor side of that dual mandate, we've seen the unemployment rate hovering around 4% for the last year. So the labor market's been pretty stable during this period. On the inflation side of the mandate, inflation has come down quite significantly since the post-pandemic highs that we've seen, but it's still running somewhat above our 2% target. But when thinking about monetary policy, the important point that we have to be thinking about is not where the economy is today, but about where it's headed. And given the uncertainties that we're seeing from potential changes in national policies, I know some of which we'll likely get into later today, whether it's tariffs, regulatory policy, immigration, or changes in fiscal policy, those uncertainties make forming an outlook quite challenging. So I'm really focused on the risks. And when I look at the risks that we face, they're balanced on both sides of the mandate. Of course, tariffs could increase prices. And if those prices in the short run were to continue to change inflation expectations over a longer period of time, that would be quite significant in thinking about our outlook. Fiscal policy or changes in regulatory policy could change capital investment and demand from consumers. But on the other hand, the uncertainty and market volatility that we've seen could cause businesses and investor and households to really pull back on investment and spending. So they're really two-sided risks that we face. I'd say for now, with the labor market being very stable, inflation coming down slowly, but still above our target, and these balances of risks on both sides of our mandate, I think monetary policy is really well positioned for us to wait and be patient and watch the data, knowing that if the risks are to materially change on either side, we're well positioned to act.
Great. You've talked particularly dealing with inflation and the subject of inflation.
I think this is a letter. Okay.
Great.
Great. Can everyone in the back hear me now? Is that better? Were you able to hear me on the current state of the economy?
We want to start
Seems
over.
like an important part to start with, so I can come back and just emphasize. I think, just in a very thumbnail sketch, I would say that the labor market is pretty solid, inflation has been coming down slowly, but still above our 2% target. And we're seeing risks on both sides of our dual mandate that appear fairly balanced. That leaves us well positioned, I think, to wait for the data, to be patient. And then if we get significant information that really changes the outlook on the balance of risks, we'll be prepared to respond. So hope that thumbnail sketch brought everyone up to speed as we think about the questions. And I know many of you are entering questions into Slido, and I look forward to seeing them.
Speaking to inflation, you said coming down, but there's been a lot of concern out there. In the past, you've talked about higher inflation expectations becoming entrenched. Could you talk more about some of those particular risks? How do you work to ensure that inflation expectations are well anchored as a central banker?
Well, we see from the surveys that we conduct, those that we do in the 11th District and those our other Federal Reserve District colleagues conduct, and from market-based measures of inflation expectations, that households and businesses anticipate higher inflation in the short run. Now, the key risk to our outlook is that those higher expectations for inflation from tariffs or other potential shocks extend well past the period of those shocks affecting the economy. And then the risk is that those expectations become entrenched. What we've learned throughout history is that if inflation expectations are to become quite entrenched, it becomes very costly to get them back to 2%. Means policy rates being higher for longer. It means a larger effect on the labor side of the economy. And that's really what our job is right now. Our job is to ensure that a one-time increase in the price level doesn't become an ongoing, persistent problem of inflation. So that's really why I think focusing in on inflation expectations is so important.
Great. You know, recently the Dallas Fed, under your guidance, launched the Global Institute, which focuses on policy-driven research on global trade, international capital, and migration flows, with in particular focus to Mexico. How are you thinking about the current uncertainties surrounding the economic impact of tariffs based on our relationship with Mexico in the 11th District?
Well, I'm really excited about the Research Institute that we launched in the fall of last year. It really builds on the strength of the research here at the Dallas Fed and of issues that are so important to our district. As you said, the mission of the Research Center is to focus on both regional and national trends on issues of immigration, trade, and capital flows. And those issues are front and center right now. So the starting of the center was timely. We're seeing, of course, a lot of focus and uncertainty on issues of trade. So the Research Center is focusing on that issue. We know that tariffs can lead to higher prices, and they can lead to higher unemployment. So we really just have to understand the risks. I think about some of the research really focusing on a couple of questions with respect to the potential implications for inflation. One is, understanding the policies themselves and whether changes in tariff policies from here in the U.S. We see retaliation from countries that are affected as an important factor. A second is how those tariffs pass through from businesses to consumers. Do they pass fully through? Are they partially pass through to consumers? And how long does that pass through ultimately take? And third, the issue we've been focusing on, do we see an unanchoring of inflation expectations? One of the things I think the Research Center can do is bring the qualitative information that we're hearing from businesses across the district with the research models. And one way that I thought was pretty interesting recently is in our most recent Texas business outlook surveys, the ones that was conducted in the previous cycle, there were a series of special questions from businesses on tariffs. And if you didn't have a chance to look at that survey, I'd encourage you to go back. I thought there was some really informative information from our business leaders around the district. I think about 60% of the survey respondents, businesses in the 11th District, said they anticipated being negatively affected by tariff policies. And I would say, I think it was about 50% said they anticipated passing through those increase in prices to the ultimate consumer, and about 25 of that 50% fully passing through those tariff costs. And that we understand that, while some of those price increases could happen immediately, we also learned from our businesses around the district that for many cases it would take several months. So that type of qualitative information is useful in putting into the models of how these potential policy changes could ultimately affect the overall economy. So I'm real excited about the center because I think it directly relates to the policy issues that we're facing, both in providing new research, but also bringing opportunities to convene and talk about these major issues. So I encourage you to look on the website to see about upcoming events, upcoming research and data that we're doing.
So lots of talk from the banking community and others in the economy about forward-looking indicators and data. What forward-looking or leading data is the FOMC reviewing to make policy decisions in this uncertain environment?
Well, I can only speak on behalf of my own views and not those of the larger committee. But I think in periods of such uncertainty, like we're facing now, I think it's really important to look at a wide range of data and not get too focused on any particular data point. And that's both economic data that is collected nationally, but also the qualitative data that we collect from our surveys and from conversations like today. I would focus the conversation on a couple themes or things that I'm really thinking about. First and foremost would be inflation, of course. We know that inflation has been coming down slowly and in a bumpy way, but it's still sitting above our 2% target. One measure that I like to look at, because it's not only important where inflation is today, but about where it's headed. I like to look at the Dallas Fed trim mean. That you can see that on our website. And the reason I like that measure is because it cuts out the outliers of the inflation print and allows you to have a good sense of the underlying trend in inflation. So that would be a first place I would go. Of course, inflation expectations are also important. So I'm looking at both survey data from consumers and businesses, but also market-based measures of inflation expectations. I really think market-based measures can be quite informative, but one challenge that we see in them is when markets are volatile, like they've been in recent months, they can become a bit distorted because of illiquidity in those products. So I think it's really important to be looking at both survey and market-based measures of inflation expectations. On the labor side, I think we have to look at a wide range of indicators. We know that the labor market was particularly tight coming out of the pandemic in 21 and 2022. Since then, the labor market's cooled, but been pretty stable with a balance of both supply and demand on the labor side. And as I said earlier, the labor market unemployment's been hovering around 4% for the past year. So inflation expectations, a wide range of labor market data I think are particularly important. The other thing I would just highlight is that in periods where there's potential for transition in the economy, our data often comes with a lag and can be backward looking. So another thing that I like to look at is higher frequency data. And during the pandemic, the Federal Reserve did a lot of work to collect much higher frequency data because the economy was changing so rapidly. So we produce here in Dallas a weekly economic indicator, which I'd encourage you to look at, which is just taking this very high frequency data. And when we look at that weekly economic indicator, it's been pretty stable in terms of economic growth over the last several months. So I think those would be some of the indicators I'm particularly focused on right now. Overall, as I said, I think monetary policy is well positioned for the potential risks we're facing, and we'll just keep watching the wide range of data that we get.
Great. Let's get back to the Federal Reserve's dual mandate, both the price stability and maximum employment, guiding monetary policy for decades. Given the complexities of the economy today, do you believe the dual mandate remains effective and a relevant framework, or does it sometimes present competing priorities that are increasingly difficult to reconcile?
Well, the dual mandate of price stability and maximum employment is given to us by Congress and our elected officials. And only Congress can change that dual mandate. But I think it's important to emphasize that dual mandate, I think, provides many positive benefits to both households and businesses in the communities that we serve. And missing on either side of that mandate would be quite costly for our economy and our communities. I would say that most of the time, that dual mandate is not in conflict. But there are on occasions moments when they might be moving in opposite directions. And as I talked about earlier, the potential risks coming from tariff policies or other national policies is to higher unemployment and higher inflation, which means that those two objectives could potentially be in conflict. And if they were to become in conflict, we would take a balanced approach to thinking about policy. We'd look at how far we are from each of those sides of the mandate and how long it would take, or we would expect it to take, to return to those goals. And that's the approach that we would take if they were to become in conflict. So overall, I think the dual mandate serves us quite well as an economy, and we'll be focusing on both sides, the risks on both sides of the mandate.
Great, thank you. You mentioned recently in a speech the changes in regulation could be stimulating to our economy. What do you see on the horizon for changes related to banking regulation?
Well, each of the Federal Reserve districts have a delegated responsibility for supervisory activities in their district. And our job is to ensure strong implementation of any regulatory changes made by our federal regulatory agencies. It's not the responsibility of the reserve banks to make determinations about those regulations, but of course, our job is to make sure they are implemented effectively. So I do want to be careful and not get ahead of my colleagues who are making decisions about regulatory policy. But when asked, I think a core principle I think about when I think about banking policy is really ensuring a level playing field. Emily had some really nice opening remarks, I thought, about the importance of a diverse banking system and how that supports our diverse economy, both small and large communities. And so we need to make sure, I think, in policy that small banks and larger banks are on a level playing field. And oftentimes we see that larger banks are potentially perceived by depositors or others as being too big to fail. And that creates, I think, challenges in that competition of the banking sector. Now, I think that's true, a level playing field in any sectors of our economy. I think a level playing field is important for competition. It's important for innovation. And so I think we want to look at policies with that lens in mind. Two that I've really been paying attention to as I think it affects the banking sector is issues of liquidity. We saw after the challenges with SVB, just the challenges of maintaining liquidity and the potential of movement of deposits. So I think really looking at deposit insurance and the structure of deposit insurance to make sure it's modernized for a level playing field of our small, medium, and large banks is really important. And I think it's important to be thinking about tailoring of regulatory policy as well, so that the risks and the regulations match in terms of our overall economy. So while I'm not voting on those regulatory policies, I think I look at those issues through the principle of level playing field and fair competition. And I think that leads to the innovation that we want to see in the banking sector more broadly.
Great. Changing things up, a big subject out there, stablecoins. Why aren't stablecoins being regulated like banks or mutual funds? And what do you see as the role for central banks in regulating or issuing stablecoins?
Well, when I think about stablecoins and the potential changes, it matters a lot what the overall structure of those instruments look like. And I think the legal issues are being debated in the Congress, as we speak, about what the potential structures may look like. So I wouldn't want to get ahead of where those discussions go. But ultimately, how they are regulated or supervised will be determined by those structures. And it could involve, depending on the outcome, a number of different agencies. When I think about what stable coins are, uh, they have some features that really present run risks, like we've focused on in banks or in money funds. And so we want to make sure that those type of run risks are appropriately supervised. But they also have features of payment instruments. And we know that clearing and settlement of payment infrastructure can often fail. So we want to make sure that they have a good regulatory and supervisory framework around the payment aspects of those instruments. So they have characteristics, I think, of banks, but also of other types of entities, and they're important payment instruments as well. So I think making sure that these legal issues and the structure of the instruments are clarified, and that there's a strong regulatory apparatus around them, so that we can make sure the financial stability and other risks are appropriately supervised. Again, I'd come back to the principle I talked about earlier of level playing field, and I think that level playing field applies here too. I mean, we want to make sure the risks that the instruments are posing are supervised on the same terms as the similar features of those risks in other instruments, and that's the broad principle I would take to thinking about the new development. I am glad that we're talking about it, though.
Yep.
I think that it's important in all of these type of convening sessions that we have that we spend time understanding the changes. They're happening rapidly, and they could intersect in really important ways with the banking sector. And so I do think it's important that we continue to talk and advance education and understanding of them, so that bankers are well prepared for any potential changes that could occur.
Thank you. I know that bankers in this room are watching that very closely. The Dallas Fed recently published results of the Texas Manufacturing Outlook Survey that had some interesting findings on how Texas firms are utilizing AI. What were the main takeaways from those results, and how are you viewing longer-term impacts of AI on our economy?
Well, as I said earlier, we produce a number of surveys with businesses, with bankers like yourself. I hope many of you fill out that survey, and if you don't, want to make sure that we get you to do that while you're here, as well as the energy sector. One really interesting question that we asked in the most recent Business Outlook surveys was about AI, and there were a couple of points that I thought were really interesting, and you may find interesting as well. Um, we know that AI is still in the early stages of adoption, particularly Gen AI as well. But we found in the survey that 40% of firms, and there were 400 firms that filled out the business survey, 40% are using AI today in their work, and almost 20 expecting to do so within the next 12 months. So that's a pretty significant change, and we are asking this question every several months to sort of understand how this dynamic is changing. And of the 40% using it, half of them are using generative AI. And that's happening in firms of all sizes, though we did note that larger firms are more likely to be using AI, with several smaller firms just noting that the type of skills and expertise needed in the workforce are quite challenging. A range of use cases are cited. Most of those who are reported using it are focusing on data analytics, as well as customer service activities. But importantly for the group here today, fraud is also another important risk that AI is being applied to. The second thing I noticed is that 72% of firms report little impact on employment right now. So a key issue for us, given our dual mandate, is to understand how AI affects the workforce over time. And so I did think it was notable that 3/4 of the survey responses are not yet having an impact on their workforce, but many do expect there to be changes, particularly as higher skilled jobs that haven't been as much affected by innovation, I think are likely to see some impact from AI. I think what we learned in the survey from firms is the degree of that impact, though, will importantly be determined by the cost of AI. It's pretty expensive right now. So even if you can replicate some activities, you have the cost of using it relative to the cost of labor. And we know that in any time of innovation, we also create new jobs. So exactly what the effects on the workforce will be are still pretty uncertain. And the last theme that really came out are the risks. And I know we're going to spend some time thinking about those risks. It's a great tool, for example, can be used in cyber and fraud and mitigating risks, but it also creates misinformation. And so I think most firms that are reporting use of it still are seeing a human in the loop to both review the output and potentially revise the output. So some pretty interesting data. We know it's moving quickly, but still a lot of uncertainty. And I think we're still in the early stages. And I think surveys like this can help us better understand how that dynamic is changing.
Great. Lorie, you almost weekly you're out. And I can say you were out in our part of the world in the Corpus Christi area recently or last year and took a trip on the Inner Harbor over almost 2/3 of all oil exports connected from the Permian to the port of Corpus Christi that go out to the rest of the world, particularly to Europe. And then we were over at Cheniere.
Yep.
You got to see that as
Yep.
well firsthand. You're traveling quite a bit. You're getting into the districts. You're talking to customers of banks. You're talking to business people. What are some of the major themes that you have learned from those trips around your district?
Overall, what's struck me, I've had, just the great privilege of traveling all across our district. I think the thing that, continues to come across to me is just the power of the diversity of the economies in all the regions of our district. And that diversity attracts businesses because of the close location. So we have energy in Houston, in Corpus Christi, in the Permian, we have high tech in Austin, finance in Dallas, finance and manufacturing in Fort Worth. And later today, I'll be in El Paso, and trade and manufacturing are so important. And when you have that diversity of strength of those economies, companies come because they can quickly integrate and connect with workforces that are well trained in those different sectors of our economy. I think issues that came up in our visit when I was there, I think are the ones I continue to hear about. Workforce is front and center.
Yes.
We can't keep attracting corporations to move here if we don't have the workforce to support it. So issues around early education, certification, being able to bring people back into the labor force, critically important. And many communities around our state are focused on how best to do that. And then the structural issues. One that you and I talked about a lot on our trip to Corpus Christi is water. And I know for many communities, water is a key medium run structural feature, as is power, particularly with the growth in AI and data centers. So I think I've been real pleased to see that power and water have been issues front and center in the legislative session, because I do think those are important to addressing these structural infrastructure issues that are needed for our communities to continue to thrive.
Good, thank you. And you're right. Lots of concern. I think workforce, power, water continue to be things that communities are really challenged with as well. But let's get back to one of the things you just spoke about. Is your district covering many important energy markets? We talked West Texas. To our part of the world, it's by pipeline.
Yeah.
Those export markets for our oil and natural gas and other things, Houston being a good component. What's your outlook on that energy market? What are you worried? Are you worried that lower oil prices are going to start impacting production? What are your thoughts there?
Well, when I go to the FOMC meeting, one of the important things I think about is making sure to bring the perspective of the energy sector to that conversation. And I'm always taking some of the time when I talk about the economy to focus on energy. And one of the places I go to do that, in addition to the many conversations with business leaders, is our energy survey. And I think a theme I learned from that survey is just that the break-even price for investing in new wells, I don't know, somewhere around $65, $66. That really matters for thinking about overall production levels. And with prices really coming down, I think that break-even price is being challenged. And we saw in our most recent survey of energy executives that their capital planning for 2025 has been pared back because of the softer prices. But overall expectations for production haven't shifted too meaningfully yet. But I think that's a risk, of the potential for for lower oil prices, because energy is a really important driver of our economy, less so given the diversification of our district's economy now, but still important, and for labor here in the district. So it is an issue we're watching quite closely. And in the next round of the energy survey, I'll be looking to see whether energy executives have made any further adjustments to their 2025 or even looking into 2026 capital plans, just given the lower energy prices.
Thank you. Now we're going to switch over to your questions that you've provided. And if you have an opportunity, you can like some of those questions, or you can provide your own. And I'll just start with the first here. Could you speak to the future of Fed payment rails?
Well, I think that the key issue that we are really focused on, I mean, we want to make sure that the work that we do in payments is ensuring a safe, efficient set of payment rails. And FedNow is really the key initiative that we have in place. One of the important drivers of FedNow is to ensure that these instant payments are available to banks of all sizes. That was an important driver. So we've been particularly focused on making sure that FedNow is out and available to institutions, and we've been working with banks across our district to make sure they have access to use it. And I know we'll be talking about this later today, and I think there's going to be a booth outside the room, and I hope you'll take the time to talk with our team about what we're seeing in FedNow and share if we're having any questions. I think overall the growth we're seeing is pretty strong. We're seeing more and more banks sign up for it. Now we're seeing a lot of banks really set up to receive, and we need to continue to work on the use cases for sending. And so I'd love to have more conversations with banks in the room. I know, looking out, I've seen some of you, and you've talked with us about potential use cases, and we'd like to engage in those conversations so that we can continue to promote the use cases that are really working. Again, I would say, our goal is really to make sure that we have efficient and safe payment systems available for banks of all sizes. And that's why I think the FedNow initiative is so important.
Something you've spoken about, we've heard quite a bit at Fed board meetings and otherwise, is the discount window and readiness. Can you speak a little bit about why banks should be set up at the window and what the Fed is doing to improve the stigma around this issue?
One of the key lessons that we learned, coming out of the SVB experience, I think you've learned, we learned, is just how quickly you could see a shift in liquidity profile. Now, I've been engaged in financial markets and policy implementation for my full career, and I understood the importance of readiness. But I think even for myself, SVB really took note just how quickly, and technologies really change those dynamics. So I know all of our banks, all of you have strong liquidity plans that you think about having a diverse set of funding arrangements, and those are going to look different depending on the nature of the deposit base of your institution. But we can't anticipate the future, and there are so many risks that are out there that I think it's important that all banks are set up to be able to use the discount window, because you just never know when it might be important. The FHLBs play a really important part of our financial sector. But the window is always available. That's why central banks, are here, is to be that ultimate source of liquidity. And I think we continue to learn lessons from our side about how we need to continue to modernize that facility so that it's easy to use for you, and it's easy to move collateral. So a key initiative that we've been working on is with the FHLB system. So how do we make collateral more easily movable between infrastructures? At the end of last year, the Board of Governors put out an RFI on the discount window. Many banks submitted their views. We've collected that information. We've put it against our business and technology plans to make sure we're focusing on the issues most important to you. Emily talked about some of those in her opening remarks. We'll also have a booth outside, so you can continue to share your feedback and ask questions about it. But we want you to be able to easily use it, want to make sure our infrastructure is modern, want to encourage you to test it from time to time, because even if the executive understands how to use it, you got to make sure that those who may be working in the bank on any particular day are well positioned to be able to access the window. I'll continue to speak about how healthy banks use the window because it's important that it is not stigmatized. It is there and available and should be used by healthy banks. So I'm out there talking about it a lot. I want to make sure that bankers understand how important we think this is and how boards of directors and investors in banks think about how important this tool is to provide liquidity in moments when it's least expected. And we ask everyone to be thinking about operational readiness and testing. And that's true for the window, but it's true for all sources of liquidity that banks have. And I know you spend a lot of time thinking about that.
Interesting question here. Someone posed, it says, what's one risk factor or market shift that keeps you up at night and makes you feel that the industry is maybe prepared for or not prepared for?
I would repeat Emily's opening remarks. I think one of the things that keeps us up at night is cyber and cyber risk because it has so many vectors, and you can't be more prepared for those different vectors. I think that's why making sure we focus a lot on operational readiness and these issues. We don't know where these risks will come from, and cyber risk is one that could come directly to an institution, the third parties of those institutions, the infrastructure of our financial sector. It could hit in so many different ways. And so just making sure that you are ready in the most important part of the bank, which is in the liquidity, I think is one of the best ways to be prepared for those types of uncertain risks. Now, I know we're doing a lot of work on cyber. We have to continue to keep focused on it, and we'll do that today. But I would pair that with readiness across all forms of liquidity.
Great. And cyber is certainly one that we're all really concerned about. There's a popular question here. Given AI's potential to transform labor markets, how is the Federal Reserve Bank of Dallas assessing its impact on unemployment, something you spoke to earlier, and the broader implications for achieving your dual mandate of price stability and maximum employment?
It's a really important issue for us over the medium run. And I think that's why this survey, I think, is so useful. We're doing two things. One is, making sure we have this systematic survey so that we can monitor how things are changing over time. And also, in just about every CEO conversation I have, one of my questions is, how are you thinking about AI? How are you thinking about investment? What are the risks that you're working on? That's true for us here in the Federal Reserve System, but I know true for leaders of all organizations, nonprofit, private, and public. So I think the best thing we can be doing is tracking these changes in a systematic way to understand it. But importantly, thinking about workforce training and workforce issues. It comes back to that earlier conversation. Innovation is really important. It's going to lead to better productivity and enhancements to our overall economy, but we don't want anyone to be left behind. And so I think it's really important that in conversations like this, we're thinking about how do we develop our workforce? How do we think about certification programs so that we can continue to reskill and make sure that our workforce is prepared for the future?
Just to follow up on that, are you seeing that in the community talks? Are you seeing that communities across your district are preparing for workforce in different ways?
Well, just last week I was in Waco. I spent Thursday and Friday in Waco, and one of the areas we focused on was workforce training. And I did some remarks with the chamber, and it was in this really interesting facility that's been built just for manufacturing firms to train their employees. So you get this benefit of different types of manufacturing firms kind of working together and really getting scale from workforce training. And it's not about just their current workforce. It's also about bringing people who haven't been in the labor market for a while into the facility to get them some certifications so that they can enter the workforce. So we are seeing some really creative and important developments taking place in different parts of the district. And one of the things we're doing is going out and learning about them so that we can highlight other communities these best practices that we're seeing be successful. And I think that initiative is a particularly interesting one for communities around our district to learn about.
Great. Stablecoins, again, certainly top of mind for many bankers in this room. Could you speak to concerns regarding stablecoins using the Federal Reserve for their master accounts? Is there concern about the implied guarantee or deposit coverage when these holding accounts are housed at an insured depository institution or at the Federal Reserve Bank?
So I think this question, the broader question, is getting to thinking about access to novel accounts. We spent quite a bit of time building a framework for making those decisions and making sure that they're consistent across the Federal Reserve System. I would say I would come back to the overall principle that I think is important. We want to make sure there's a level playing field that allows for innovation, but that we have good, strong structures to ensure strong regulation and supervision to like activities. I think there's a good structure for those applications that are in place. And my work, the work of our team here, is to make sure that we're evaluating them against the principles that are consistent across the whole Federal Reserve System.
Great, thank you. I know more to come on that issue. We've seen a lot of large government policy changes on what seems to be a near daily basis this year. How would you decide whether a policy change is relevant enough to affect your stance on monetary policy today versus waiting for it to be reflected on economic data?
Well, I think with so many important national policies up for discussion right now, it's really important to make sure we're thinking about not only how they might impact the economy over time, but making sure we really understand how it's affecting the economy right now as well. I think we're well positioned at this current moment to wait for the data to come in, make sure we have more certainty about what these policies are going to be. That's because the labor market is in a good position and really strong labor market. We still have some work to do on bringing inflation back to our 2% target. And we are seeing risks on both sides of the mandate from these potential changes. So while it's important to understand how they might affect our outlook and use all the best modeling that we have, I think we have the time, and I think we should remain patient to actually see how it starts flowing through the data before we make decisions. And when we do see those risks change in a material way, we're well positioned to respond.
And I guess a follow-up to that question, relative to what we're seeing on the geopolitical stage across this world, is on a broader, in the broader sense, is removing sanctions on Syria, or geopolitical risk versus sanctions. As a follow-up to that, feeling like that things are stable enough on the employment side, are your concerns there as well, that something can change something very quickly, and how quickly you respond? How would you look at that?
Well, I think the question is also talking about geopolitical risks around the world. And we do and have seen for quite some time heightened geopolitical risks that have been in the forefront of our minds that could provide a potential shock to the economy that we'd have to respond to. I would say that geopolitical risks is also in that bucket, of trade policy, fiscal policy, regulatory, and immigration. There are a number of potential factors that could be affecting the economy, and we're looking at all of them.
Great. In terms of the attention being given to consumer pricing as a potential result of tariffs, are there any potential positive results from tariffs on our economy that should be equally considered?
Well, I think when we think about these national policies, tariffs, immigration, fiscal, and regulatory, those are importantly are policies that are determined by our elected officials, and they're bringing into perspective a number of trade-offs that are being thought about with each of these. So, I think those are important, for elected officials. I wouldn't want to get in front of any of them. From a monetary policy perspective, I have to think about how they might flow through the economy and make sure that monetary policy is well positioned as we get information about certainty around them, as well as their implications for the economy overall. So, I think tariffs do present a risk with respect to inflation and to higher unemployment. There could be other national security and economic reasons that elected officials make decisions around those tariff policies. But our concern is around the dual mandate given to us by Congress and what the effect is on maximum employment and price stability. And that's the work that I'm doing. That's the work my colleagues are doing. And that's the work that our staff all across the Federal Reserve System are really focused on.
Lorie, on behalf of the bankers and others that are in this room today, thank you for your time today. Thank you for all your leadership and what you do for the 11th District.
Well, thank you for your service to the Federal Reserve.